Hello Sector Watchers, welcome to the show. This is the 87th episode of Sector Spotlight for Tuesday the 6th of July, recording it on Monday the 5th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. I hope you in the US, you all had a very good long weekend, enjoying your Monday off, and I hope you had a good 4th of July. Today is the first Tuesday of the month, and the regulars know that that means that we're going to look at monthly charts. It is also always a full show with a lot of charts, so we're going to dive straight in. We will deal with an overview for asset classes, followed by a look at the monthly charts for asset classes before the break, and after that we're going to take a look at sectors, sector rotation of last week, followed by a quick look at the monthly charts that completed in June. This is Sector Spotlight. On the left-hand side, we have the RRG for asset classes on a daily scale, on a daily basis, and on the right-hand side, we have the same group on the weekly scale. We quickly look at the performances, then we see that the benchmark was up 1%, and a pretty good week again for both commodity indexes, DJP and GSG, 3.3 and 2.3%, and stock market up 1.3%. That makes almost by default that government bonds were below the benchmark, which they were again, but still up 40 basis points. High yield up 50 basis points, and corporate bonds almost 1%, 0.9. Not such a strong week for real estate after a very good stint, so they lost 40 bips last week. If we look at the tails and the rotations, then we see that commodities are picking up again, so that is good. They're confirming their long-term strength. Commodities, stocks, ITOT, rotated back into leading on the daily. And especially on Friday, we had a very strong day. You see that very long or big difference on that tail from Thursday to Friday. And the same thing happens with government bonds, but on the opposite side, you see the big jump from Thursday to Friday. We put that on the weekly scale, then commodities pretty good, especially GSG. And there's a weird thing, DJP rolling over while GSG is going higher. And GSG is the one with the heavy energy oil component in it, so it's not real surprise that it's happening. Overall, commodities in general still pretty good. If you look at the rotation of stocks, then we're still on that negative heading, but a relatively short tail. You can see that those week-to-week observations are really close to each other. And for me, that still makes me pretty cautious with regard to rotation of stock market in general, and also stocks versus bonds. If you look at government bonds there, then you see that positive heading has gone now. If you look at that week, so it's rolling over. Still a pretty unclear, messy. Let me put it like this, that we have seen clearer pictures, clearer rotations in the past, but hey, this is what we have to deal with. This is what the market is throwing at us right now. And I'm still watching this negative rotation. I would really like to see this ITOT tail to curl back up and start moving towards leading, and government bonds to roll over and start moving towards lagging again for a real, I mean, stocks are still on the right-hand side, govies are still on the left-hand side, so the long-term trend still in favor of stocks, let there be no doubt about it. But that trend is stretched, and we'll have a look at that a little bit later on. Let's dive straight into the monthly charts for the asset classes. Here is ITOT, and I have updated my annotations, but I've also set the charts so that they end in June. So the last day of this chart is the end of June. So we don't have that bar that only represents, in this case, last Thursday, Friday trading to distort our picture. So we're going to look at the monthly charts that ended in June. So the completed monthly bars of June. And if we look at ITOT, then we see that obviously this uptrend is very much intact. It's almost going straight up, and that's a good thing, but it's also starting to almost become uncomfortable. And I've been sort of careful with stocks for a while, and I see the breakouts, but I also see other things, and I want to discuss that with you later on. But the long-term trend here for ITOT is still fully intact. I've added some retracement levels here, and these are from the current level to the first major support level, major support area. And if you look, then that is the high that we saw in September. That is down almost 20%. And if you go to the last real high, really pronounced high, then you're already 24% lower than current levels. So if you take uptrend as higher highs and higher lows, then you need that swing from that high to a new higher low to take place at some stage. And the further you travel above that breakout level, the bigger the risk becomes, because this market can drop 20% to the previous high, and if you go to the previous low, well, let's put it very conservatively at this low here. I mean, you can drop massively without harming the long-term uptrend, and that's the thing that's in my head. We will also see that on the S&P 500. If you look at SPY, this is the long-term picture here. Similar, just new all-time high, new closing high. So that uptrend is fully intact. But from the breakout level, from the moment it broke the last previous high, that is 16% lower. And I have another one which is zoomed in. That's the 16%. And if you go to the top of that trend line or the next one, that's even more. So I mean, these are serious retracement or serious downside risks, which at least to my taste are getting mildly, slightly uncomfortable. I mean, if you buy right now, you're not buying at the lowest point. We don't know whether it's a good idea or not, but if you start buying now, I think you're chasing the market, and that's usually not a good thing. So maybe I'm too early, very well possible, but it's getting a little bit too overstretched to my taste. If we quickly go to the other asset classes, so here's golf. That's another one that is, we were coming down. We had this massive decline from 28.40 down to almost 26. We rallied slightly over the last couple of months, but we're now having trouble with this resistance area coming from that high in August, which was around 26.70. We'll have to see how that plays out, but there's definitely, this is starting to look like a downtrend. We had this completed double top, reached some downside targets. We're now recovering a little bit, but I'm actually looking for the next lower high, and then for government bonds to go lower and push yields higher, and that's usually not a very good thing for the stock market. Now, if you look at IEF, that's the 10-year bonds, you got sort of similar picture. I've lowered this trend line here that was right there, but the market decided that the support level was 112.70, and that coincides with that summer 2016 high. And if you're not too picky, then you could say that it is also in the area of the high in August 2019. Here's a little bit more upside than engulfed. But still, I mean, I think that we ended the uptrend, and the odds are pretty good for a renewed leg lower after this recovery completes. Corporate bonds, similar, completed a high. We're now trying to push back above, so we're struggling with this old support now becoming resistance. We'll have to wait and see how that pans out coming month. High yield, we are still in that trading range. We're pushing to the upper boundary. Again, wait and see how that plays out in the coming month. And then we have real estate that is still going strong. We came down during the month, but we're still above the breakout level. And compare this one to the charts of the stock market. There we broke and we extended the rally, which means that there is now quite some downside risk. If you look at real estate, then we just broke above the previous high. And if you look at the downside risk here, that's very, very limited. That's only a couple of percentage points. And even if you go down to 92, that's about, well, let's say 8-9%. Still decent, but not as much as almost 20% or sometimes even more. And then here we have commodities. These are the long-term turnaround trends. This is the month of June, completed very comfortably above that resistance level, and all the way up to 30 there is very little resistance left for DJP. And if you look at GSG, that's the GSCI commodity index, it's quite similar. Slightly this came out of a new low, the other one was out of a range, this came out of a new low, but that trend is very clearly there. And there is plenty of upside. So this is about 16 and the level here is about let's say 19, and then you can go higher. But what I'm looking at, what is more of the way I look at it, is that this is a very, very long-term downtrend that seems to be in the process of turning around, and that's what I keep my eyes on nowadays. US dollar, I'm going to skip that one. I want to take a look at the relationship SPY-IF. So that's stocks versus bonds. That is pushing to new highs. This is also very, very stretched. And I want to reshare, if you've read my blogs over the past few years, you may have seen this exercise passing a few times. And it's the concept which I call reverse relative strength. And what I'm doing there, because relative strength obviously is like this, SPY versus IF is stocks divided by bonds. That's the ratio of stocks versus bonds. But you can also reverse that, and you can look at the chart of SPY and you can look at the chart of IF, figure where your support and resistance levels are, and see what needs to happen, or what needs to happen in SPY and IF when, in this case, the ratio of stocks versus bonds will come down. So let's assume that this is a stretched measure, just like stocks, and let's say that we need a correction in the SPY-IF ratio, just like you need corrections in any trend. And let's just be very, very conservative and say that we need, like, maybe, from this breakout level, drop back to 3.4, 3.3. What would need to happen with SPY and IF for this ratio to move to those levels? In order to do that analytics, I have set up a spreadsheet which has the prices of IEF across the top here. So I took the range from 107 to 124. It's currently around 115, 114, 115. And here we have SPY, and I took the range from 300 to 460, and we're currently around 430. So right now, this is where we are. So that's 3.75. And let me quickly bring up that chart. Here you see 3.71. Fair enough, that's good enough. This is a pretty rough analytics. Now, the the shaded area is shaded around 3.4. So I looked at the chart and I say, okay, so if we're going to get a correction in this ratio and it goes to 3.4, maybe 3.3, what would need to happen in SPY and IAF for that ratio to drop to 3.4? And what you'll see is that 3.4, let's say that's here, if Treasury bonds remain the same, then SPY needs to drop to 390. If Treasury bonds also would go up, let's say here, 3.39, Treasury bonds go to 118, then SPY only needs to drop to 395. If bonds go down, which if you look at the long-term chart, I think it's more likely that they go down and push yields higher than the other way around. And we would go to 112, then SPY needs to go to 380 for that to go. If we go to the other extremes, if Treasury bonds drop and SPY rises, so Treasury bond, that's pushing yields higher and stocks higher. I think this area here is sort of, well, the markets never cease to surprise me, but this would really surprise me. We go to the other side, then if Treasury bonds go up and stocks go up, then you need to actually push higher, because here we're 3.5, we can still maintain those levels. We go marginally higher in that stock bond ratio. But to go really higher, what would be really higher? 3.8, 3.9, 4, maybe 4 is a real high number in that relationship. Well, that's off the charts, it's off this chart. Then we would, if for that ratio to push to 4, then we need a really substantial rally in SPY and Treasury bonds to remain the same or go lower. So, I mean, I hope I make myself clear. This is an exercise that I do for myself every now and then, trying to, I don't know, sort of rationalize what I see and build a picture in my head. I think 3.75 right now for stocks versus bonds is really, really high. And we're on the edge of this range. Resistance in IEF around 120. So that would cap it in this column. And, well, I mean, support for stocks, I've put it at 360. There is obviously no upside. But, you know, if stocks drop to 360, we have 3.2 if we remain at the same levels. If IEF goes down, we will reach even lower levels there. So I hope it makes clear how the interaction between IEF and SPY works and how you can flip the image around and work your way backwards from the S&P IEF ratio. Let's start with a quick check of the rotations of last week for the sectors. If we look at the table, top of the list, technology, surprise maybe, I don't know. Good week for technology. Good week for risk on assets, good week for offense. Technology and discretionary 1.8, just above the benchmark. Stellar performance for technology, 3.2%. Healthcare, quite defensive, up 2.1%. And then we've got communication services at 1.8. Everything else below the benchmark. Industrials down all the way to energy, down 1.2%. So energy been doing very, very well the last couple of weeks, but you know, last week especially not the best. If you look at the tails, quite noticeable is despite the fact that there was a very good week for tech, healthcare, discretionary, they're rolling over inside the leading quadrant. So they had a good week, but they're already starting to roll over in terms of relative strength. And you see picking up by materials, financials, industrials, staples a little bit, utilities further down into the lagging quadrant, energy picking up, and we've got real estate going through a correction, moving from weakening into lagging, and communication services been very, very stable at a very short tail, which is a good sign, means there's a steady uptrend. If we put that on the weekly version, then we see a continuation back up for energy. So I really think that this is a temporary setback and that we're going to continue the rally higher here in energy. Financials slowly but securely picking up, and that's going to be supported by the tail going into next week, which will be a short week starting today. But nevertheless, materials, financials, industrials picking up some relative momentum. And then we see discretionary tech and healthcare rolling over, and they are in the healthcare in the improving and rolling over, and we see tech and discretionary inside lagging. Now, discretionary is very, very clearly still pushing deeper into it. Technology has hooked up, albeit very, very marginally at the end of last week. Nevertheless, still inside the lagging quadrant and measured on the RS ratio scale, 1 to the third or the fourth weakest sector. So still not massively good for technology. Before we're going to take a look at the monthly charts, because this is what's maybe confusing a lot of people. And the reason why technology is still in the lagging quadrant, despite the strong performance over the last few weeks and the strong performance of last week, if you look at the longer term picture, especially at the relative strength, we're still not at the levels that we saw in the summer of 2020. So in terms of relative strength, this technology is still digesting that massive rally that we saw, and we are below 100, and we've seen this rally here is a momentum-based rally. It's a relative momentum-based rally. And whether that's going to turn this whole thing around and continue the relative uptrend, it's very hard to say. I mean, it's not even back above 100 yet. Maybe it happens this week, but even then, we need a lot more strength for technology to continue that really strong rally. And I'm gonna dive into a couple of those aspects when we start looking at the monthly charts. So here are the monthly charts for the sectors. And just as a reminder, I am using the indexes instead of the ETFs because I think they give a better picture and they're not distorted by the total return versus non-total return that we see in the XLK, XLC series. What I've done, I've updated my annotations on the chart, and I've also on every chart added the percentage retracement back to the next serious support level. So we're going to go through all these charts relatively quickly because, they're all still, I'll give you a spoiler alert, they're all still pretty good. But the risk is stretched, and I want to do an overall analysis of that risk per sector and try to bring that all together. So communication services, that trend is definitely going higher. Obviously, the old all-time highs are still further up. But from current levels, if we take the area around 215, that's an 18% decline. If you go all the way back to this breakout, that's a 30% decline, 31% decline. If we go to consumer discretionary, obviously that trend is still higher. We didn't push to a new high, we didn't push to a closing high, but the uptrend is still there, there's no doubt about it. But this trend can decline, this sector can decline over 25%, 27.5%, all the way back to this previous high without harming the uptrend. And we see that with a lot more sectors. So here is consumer staples. This is actually probably one of the exceptions, maybe together with real estate, because this broke out and the risk to the breakout level is less than 3%. This is a defensive sector, mind you. If we go to energy, this is in a downtrend, this is not an uptrend, this is a downtrend on a monthly basis, it'll be difficult to push higher right away because we're in this heavy resistance area, let's say between 407, 410. The distance to the breakout level out of this double bottom here is about 25%. That's a very decent downside risk. We go to financials. From the breakout, we're currently moving higher. This uptrend is there. There's a long-term break. That's good. That's strong. But from current levels to the breakout level, that's 16% downside risk. If we go to healthcare, then again, this trend is super strong. We broke out of a rising channel. That's usually very, very strong. We see the follow through from current levels down to, if we take this, it's pretty conservative. We're talking about 13%. If we talk about the previous real high, which should be a serious support level, that's about 17%. This is also a pretty defensive sector. You go to industrials, then again, uptrend fully intact, no doubt about it. If we go, and these are from current levels, so we're currently 866. If we go to the previous high, that's about 17%. If you go to this breakout that was more substantial, that's over 20%, 22%. If you go to information technology, that is seriously stretched. If we go to that previous high here, that's 15%. If you go to the real previous high, that was January 2020, that's about 30% downward risk. Mind you, this sector can decline 15 to 13% without harming that long-term uptrend on a monthly scale. If we go to materials, same story, super strong breakout, downside risk over 20%. If we go to real estate, one of the better sectors at the moment, limited downside risk compared to the others, -6 versus -10, still decent, but not as much as 15, 20, 30%. And then finally, utilities. Here, it's inside the rising channel. It's not a real uptrend. We're not making higher highs, higher lows, not closing at an all-time high, no closing highs. Downside risk about 8%. If I bring all of that together in the table that you may have seen before, then we see that this is market cap weights, and we see that the new all-time highs are declining. We're down to 53%. It was much higher. Only financials, healthcare, tech, and real estate reached new all-time highs. New closing highs only for healthcare, tech, and real estate. Uptrends, obviously long-term uptrends still there, just not in energy and utilities, but that's there for a while, and it will remain there for a while. I've added the column of the percentages that we talked about when we looked at the charts. And if you look at this, and this is not a very granular, very specific analysis, but this is just, if I look at this and I just eyeball the risk here, I think that's around 20% across the board with all the sectors. And that is stretched, and that makes me still very cautious with regard to stock market and the risk that's embedded in it right now. Doesn't really matter which sector we're looking at. And this concludes Sector Spotlight for this week. Thank you for watching. If you like the show, please give us a like or a thumbs up. If you want to get in touch, please use any of the channels that you see on the screen right now. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you back next week, same time, same place, same show.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.